Well, welcome back. I hope that that's helped unpack the notions of the innovations that led up to financial crisis. Now, post-crisis, everything's gone pear-shaped, is that Queen Elizabeth II opened up the new wing at the London School of Economics in November 2008. And Queen Elizabeth asked the question, why did nobody notice it coming? Is that prior to the financial crisis, is that Gordon Brown, the Chancellor of the Exchequer in the UK, stood up at the Guildhall dinner that chancellors do attend, where the financial glitterati all attend, all of the senior bankers all attend for a very formal dinner. And he said at that meeting, he said that they'd conquered boom and bust. In America, certain commentators, Greenspan I think it was, said that yes, he expected some kind of like house price correction, but nothing substantial, and that the market was going to continue to grow for many, many years. Now that's telling, because the reason that nobody noticed it coming, this financial collapse, is because nobody was looking for it. All of the data seemed to suggest that the market, the global market, was tending towards equilibrium. There was a long period of stability and growth. So there was no reason to look for it, because our models of economy, of markets that tended towards an equilibrium, were demonstrating that it was real, that everything was tending towards stability and equilibrium, and as a consequence of that, that was just going to carry on. And so it was a genuine shock when that didn't work, when crisis appeared. It was incredibly, a number of individuals that attested at Senate hearings post the crisis had said that what had occurred had challenged their understandings of the way that economies had worked that they'd held for decades. And in order to have seen it coming, you needed to be looking at the right data. And by and large, nobody was looking at the right data. But there were some people like Nouriel Roubini, Yanis Varoufakis, Steve Keen, Warren Mosler, Stephanie Kelton, probably. We're all looking at a different set of data, in that what they were looking at was private sector debt and the incidence of private sector debt against GDP. And they were saying that there's a risk that's here. And then they'd started to see some of the activities in the way that we were selling CDOs on to other people, and said that this is starting to look like very risky behavior. And we'll talk about that in a minute. So the point that we're making here is that if you have a very fixed idea about how the economy works, and within that is that you're looking at price and quantity and demand and supply, is that finance and private sector debt exists outside of your model. So it's an external shock to the market that creates a crisis of such magnitude that it reduces or brings about recessions in virtually every country on the planet. And those that didn't suffer recession because they were disconnected away from the mortgage shock suffered significant slowdown. So you've got to raise some questions there about the validity of those models. If something that comes from outside of your model of economy is so shocking to your economy, what validity does your model have? And that needs to be challenged and questioned. And that's exactly what Minsky did. Minsky, bit of a genius. And Minsky produced what's referred to as the Minsky's financial instability hypothesis. His theoretical antecedents were Marx, Schumpeter, who was his PhD supervisor, Irving Fisher, who wrote the debt deflation theory after the Great Depression in the 1930s, and Maynard Keynes. Now, it's a strong tradition. but all of them are disequilibrium economists. So it's a tradition that's outside of the mainstream. Now, Minsky wasn't able to publish in any economics journals because his models weren't about equilibrium. So unless he was able to actually demonstrate equilibrium within it, is that none of the big economics journals were ever likely to publish him. He also wasn't, I mean, he was a mathematician, but the instability hypothesis is not a mathematical model. People have subsequently turned maths into it, most notably Steve Keen, who has a software package called Minsky, which you can download for free if you want to. But I warn you, it's not easy to use. It's not very intuitive. But the maths is different. Keen's maths involves differential equations, whereas most dynamic stochastic general equilibrium models use linear equations, where economies tend to work in straight lines, which is fine. But if the system, the economic system, is dynamic, then curvilinear equation is the only thing that you could use in order to be able to portray it. And to be brutally honest, is that at the time that Minsky was writing, is that that sort of maths was not really readily apparent. So Minsky took his work from trying to understand the Great Depression, and he asked the question, could it happen again? And also, why has it not happened yet, or since the Great Depression? Now, in doing this, is that what Minsky has done is that he took an analysis of the Great Depression, an analysis of the financial panic in the US there's a number of different financial panics in the US in the 19th century, but he took the one of the 1890s, I think, which was a big one. It's either the 1890s, the 1870s, but it doesn't matter. It's financial panic in the US. And he looked at the pattern of behavior and looked at the data, and then he came up with a model that incorporates crisis as being a normal part, or incorporates bubbles and crisis as being a normal part of his activities. So Minsky didn't take the idea of a crisis as being something that was unusual. It was a normal part of economic functioning. But actually, within Minsky's hypothesis, is that crisis is inevitable. It's not just a case of it might happen. It's more a case of it will happen if certain things are not either regulated or brought to bear. So it requires a theory with which crisis and depression is one possible state of the economy. And that's, in a nutshell, what Minsky's instability hypothesis does. Because it contains money. Now, we know within our axioms of economics is that money is only considered to be a veil over barter. And beyond price increases, it has no general macroeconomic effect. Well, Minsky rejects that completely. It's also cyclical. It goes on, follows patterns, like financial cycles. And it's embedded in time, in an unknowable, uncertain, in a Keynesian future. The future is not known. And it contains different agents, not just producers, suppliers and consumers, or demanders and suppliers, which in microeconomics is within the same household, by the way, which I've always found to be quite odd. But within Minsky's model, you've got workers, you've got banks, you've got capitalists, and you've got governments. So it's more of an accurate description of our economy from the off. And it's a descriptive model, and there are different stages that are within it. At the beginning of a financial cycle, maybe post-recessionary period, the economy is doing well, but firms tend to be conservative. Estimates of future cash flows are low is that people can still remember the previous downturn. Firms and banks are very conservative and risk averse. But within an economy that's growing slowly and a conservative financial outlook means that most of the investments succeed. They're successful. Is that our yields, our expectations of the yields are low. So if they're low and we're not investing a huge amount of money anyway, is that you got more often than not, is that those investments will be successful. Debt's easily covered, money that you've had to borrow in order to invest in the first place. So it therefore pays to borrow, which means that the market, investments, people that make investments, businesses, banks, etc., start to become less risk averse. There's a growth in investment, and also the price of the level of assets that people are starting to buy, because you're now getting flows of money into those various assets, which increases the price. But as the prices are going up, people are looking at them and saying, well, we should be investing in those assets or those businesses or whatever it is. And that's when you start to move from a very conservative economy into a euphoric economy. And this can be combined with increased interest rates, which puts highly leveraged firms at increased levels of risk. So those firms that are highly leveraged, borrowing excessively, is that once you get an uptick in the interest rates, which interest rates and monetary policy can be increased in order to try and depress the level of activity in the economy to try and stave off inflation, is that it only means that those who are operating at a very strict margin can shift into default very, very quickly if they can't find additional financing. In other words, you only need a small increase in interest rates to mean that it's not possible to start to repay the interest rates off. And at this particular point is that, according to Minsky, is that you enter into a Ponzi stage. Now, the word Ponzi actually comes from a Ponzi scheme where you are paying off new entrants into the scheme you're paying off the original entrants into the scheme with new people coming into it with new investments. But nothing new is happening. It's just a churning of money to the top. And it's what's known as a Ponzi scheme. And it's named after the guy that invented the scheme, which was called Ponzi, Mr. Ponzi. So in a Ponzi financing period, what you're doing is that you're trading on assets on a rising market by borrowing. Yeah. So the cost of the debt is higher than the actual cash flow that you're making back from your investments. And that's the risk that you run. Rising interest rates and debt to equity ratios affect the viability of all business activities. So you go from conservative to speculative and into the Ponzi scheme. Once Ponzi financing occurs, where people are using the increases in the prices of the assets to pay back the loans that they've taken out, there is always a risk of wholesale default, because it requires that the price of assets continue to go up. And once you start to get that slowdown, is that banks will find that customers can no longer pay off the debts. And that's when you start to move into crisis territory. Because in order to pay back the debts, one needs to sell the assets. And you sell the assets and people sell the assets and people sell the assets. Well, the price is going down as you're selling the assets because they're being revalued in a mark-to-market basis. And it's the role of the government to offset the worst of the impending crisis. And one of the reasons why the global financial crisis was not quite as traumatic as the Great Depression is because governments across the globe had built in all kinds of automatic stabilizers. Income support, housing benefits, unemployment benefits, as well as things like free schooling and free healthcare. It meant that those that were losing their jobs or had lost money were not in a very precarious state of poverty, or they were not at risk of losing everything and not being able to function, because at least the automatic stabilizers would kick in and provide them with a basis of an income. And Minsky saw that being the role of the government, is to offset the worst of the impending crises. So in Minsky's words, stability, that long period of stability, which has been referred to as the Great Moderation, before the collapse is destabilizing, because at that period of that stable period, at the end of that stable period, is where all that Ponzi financing is entering into the market. And once you get a recorrection in the price of the assets, is that those firms and individuals that have taken out financing to buy the assets, but are now losing money because they're suffering with negative equity and higher interest rates, is that ultimately you'll get a collapse. Collapse in the asset price, which means that people are defaulting on all kinds of financing, which will cascade throughout the system, the financial system. And as a consequence of that is that the world, or the economy, and it depends how interlinked it is, will tip into crisis as the bubble that's been created pops and there's a recorrection. Now, Minsky's view is that this is cyclical, is that after every cycle, there's a residual of debt that's left, which is higher than the previous one. So after this financial crisis in 2007, 2008, there was a residual level of debt that didn't go away, but it was higher than in the previous financial crisis. So the world continues again in a conservative stage, but at a stage where there is a higher level of debt already in the system upon which it builds. So let's look at Ponzi financing. As far as the crisis was concerned, 2007, 2008 crisis was concerned, Ponzi financing started to occur when mortgage brokers were selling mortgages to people that basically couldn't afford them. Huge demand for new mortgages in order to increase the size of the coupon pool so that we could continue to churn creating CDOs and derivatives, meant that brokers were selling mortgages to people that effectively couldn't sell them, couldn't afford them. But the way that they did it was by suggesting that they could have a low rate for the first 9 months, and then there was a jump up in rate which represented the real risk to the mortgage broker. But because the market was buoyant, it allowed people to take the house for a few months and then sell it again, but at a higher price than what you paid for it, and use that to pay back the money that you'd borrowed in the first place. And that's Ponzi financing, isn't it? Because that only works if the house prices continues to go up. Or once you run out of people to sell mortgages to, there's no new entrants into the market, so there's a flow of credit. The flow of credit stops. And if you want to see what house prices are doing, is that you look at the rate of new mortgages that are being taken out. If new mortgages are being taken out, then house prices will go up. If there is a slowdown in the rate of new mortgages, house prices will fall. Because the flow of money into houses declines. And then it's inevitable that the price of the houses has to go down. So in the US, everybody who wanted a mortgage had got one. So it was inevitable that new mortgages would slow, which means that you're going to slow the price of houses down, which means that it's going to be difficult, much more difficult, to be able to flip the house and get the money back so that you could pay off your original loan. So consequently, what happened is that there was a huge amount of defaults from the subprime sector. The subprime sector kind of collapsed. And people were left with a choice as to what do they do? Do they continue to try and service the debt, renegotiate it with the banks? But the banks were under pressure anyway because they got defaults that were going on. Or do you just walk away from it? Just pack your stuff up and just leave. And many did. They just packed up, left the keys in the door, and the banks reclaimed the properties. But the banks effectively didn't want the properties at that stage because there was nobody else that was going to buy them. And it took 2 or 3 years, but then large companies stepped in to decide to buy up distressed properties, and that was BlackRock. And if you look at BlackRock's portfolio, a lot of it is on rental properties. But incidents of more Ponzi financing. And it's interesting when you look at the rate of securitization of mortgages in the US now. And actually, the amount of mortgages is way higher than the securitization of mortgages is way higher than it was in 2007, 2008 even. The difference is that now is that most of the mortgages are being securitized by agencies. This is Fannie Mae, Fannie Mac and the others. So they're government supported agencies. So they're perceived as being more and more secure. But that's what they thought earlier, wasn't it? But you can see there's a difference in the non-agency mortgage-backed securities here were banks and realtors operating in their own interests. Now that's not occurring now, but that doesn't mean to say that there's still not some risk that's being built up into the system based upon the selling of mortgage-related securities, mortgage-backed securities. The market's bigger now than it was in 2007, 2008. Does that mean we've got an impending crisis? Well, it would depend upon whether or not there's any evidence of Ponzi activity going on, and I'm not close enough to it to know. But if Minsky's right, it's a matter of time. And there are other asset vehicles or asset classes that are demonstrating similar potential problems in that the amount of leveraged loans, i.e. loans that are financing mergers and acquisitions, is much higher now than it was in 2007, 2008. Now the spread is much lower, I get that, so they look like they're a lot riskier. But what if there is a recorrection or a lot of those mergers and acquisitions don't deliver any value? Is this another bubble in an asset class that potentially has got a lot of risk that's contained within it? Is that how are people getting the money in order to engage in buying mergers and acquisitions? Well, they're borrowing the money on corporate bond markets. But nearly 50% of all corporate bonds are at or below investment grade. Is this an indication of Ponzi activities? Is that people are borrowing money at levels of risk that are non-investable, but people are servicing it. But there is a level of risk that's in there because it's non-investable. 50% of the corporate bond market is non-investable grade, which means that there is a risk that's in there, isn't it? So that's mortgage-backed securities, potential risk. Leverage loans, another potential risk. And subprime loans on cars are also growing. And again, if you look at from 2007, 2008, 2009 up to the current day, is that the amount of loans on cars that are subprime is higher than any point in our history. Again, it depends upon how people are financing these sorts of things. It might not be any risk in it at all. But when you start to look at the delinquency rate, is the delinquency rate on subprime car loans is at the lowest point that ever has been in 6 years. So that doesn't seem to be a risk. But when you actually dig into this and find out why the delinquency rate on car loans is so low, it's because of the fact that the payments that the federal government made to these people of America as a consequence of the pandemic, $600 checks, $1,200 checks, and so on and so forth, is that for some people who were servicing car loans, they earned more money during the pandemic than they did while they were at work, which is remarkable, isn't it? Utterly remarkable. Which meant that they were able to service the car loans. Now, when that financing dries up, which it is doing now, would we expect to see delinquency rates increasing? Well, who knows? But there's a risk there as well too, isn't there? So what have we now got? Mortgage-backed securities, leverage loans, subprime car loans. And then stock markets. Now, stock markets are interesting because the stock markets are dominated by the big tech companies. And the big tech companies have got plenty of money in order to be able to ride out tricky patches and so on and so forth. And they seem to be bulletproof. But I guess all it needs is a recorrection, or for somebody to either deliberately short one of the big tech firms, or to start to show an interest in other financial assets across the globe. In other words, if the yields on stocks start to slow down, then other things will become more appealing, like emerging markets, and that might lead to a wholesale shift. Now, we don't see that yet, and in actual fact, analysts would say that the stock markets are still underpriced. The big tech firms are still underpriced. But that's only on the basis of the fact that people are still spending money on them. And personally, and this is my own opinion, so you take this with a pinch of salt, I think it's the ESG, exchange traded fund phenomenon, along with the shares being bought back by the big tech companies as well, that is driving the stock markets and share prices. If we move on to the next big thing, the next new thing, that could be a recorrection. I don't know. I don't want to frighten you, but there's all sorts of risk that's inherent within the financial system, which, if according to Minsky, and Minsky was right, is that there is another financial crisis. It's not a case of when is the next financial crisis, or it's not a case of will there be another financial crisis. It's more a case of when will it be. So let's go back to looking at dear old Minsky. Okay. And you can see that on the blue curve in the early 1990s, after recession, the recession in the recessions are the grey bars, by the way. So you end up with a recession in the 1990 and slowdown in the financial cycle, which hits the bottom in around about 94, 95. And that would correspond to the conservative phase of Minsky's financial cycle. And then it picks up, slows down a little bit, and then really escalates. And that's the exuberant stage, and then the entrance of Ponzi financing. So the financial cycle hits its peak in 2006, 2007, and then credit dries up. Nobody's borrowing anymore. No demand for credit. And the financial cycle goes down, but what's interesting is that there is a commensurate decrease in real activity as well, in that you get that next grey bar in 2008, 9, halfway through 2009, that recessionary period. And that is on the basis of Minsky and Werner's work, that broadly speaking says that aggregate demand within an economy, or a good proxy for aggregate demand, is the amount of credit that's issued, the amount of new money that's issued into the system, which turns over the system. And once the rate of growth of credit slows down, as it does there, as the financial cycle drops, and the financial cycle is determined by property prices and by credit growth, credit aggregates. Once the rate of credit growth slows, is that the economy inevitably tips into recession, as predicted by one Hyman Minsky.